This is Capital Ideas TV. Coming up, the head of Profound Medical quietly building another winner, and the CEO of cloud invoice company VersaPay on a transformative deal with RBC. The CEO of Profound Medical has already built two companies. One was sold to IBM, the other to Stryker for $700 million US. Now, Arun Menawat wants to complete the hat trick with Profound Medical, which specializes in ultrasound technology. Some analysts say the shares have triple-digit upside. Here's our conversation with Arun Menawat. Arun, let's have the viewers get to know Profound Medical. You've got one main product that you're developing, Tulsa-Pro. Tell us about that.
That's right. So Mark, Tulsa-Pro is a product that uses real-time imaging and ultrasound for heating purposes. So the idea is that we're trying to develop a new treatment for prostate disease. And today, most of the time when a patient is diagnosed with prostate cancer or any prostate disease, they are told, don't do any surgery, don't do anything, wait for 10 years because the side effects of what's available today are so high. These are like urinary incontinence or bowel function problems. Nobody wants to live with those. So the surgeon would say, live without treatment for a while because you're not likely to die, and they monitor the disease, and 10 years later they get treated. We're using a real-time MR to be able to visualize the cancer, visualize the prostate. The surgeons can very precisely design exactly what part of the disease, where is the disease tissue, what part of the prostate needs to be killed or ablated. And then we have a robotic system that goes about and does it under the guidance of the surgeon. So this approach gives us the precision that is needed to remove or reduce those side effects. And that's what we're doing, and that's what's so exciting about it.
And you're hoping for FDA approval in 2019, is that correct?
Yes, so we have a CE mark. We've already launched the product in Europe. We're getting good reception. In parallel, we're also doing a pivotal clinical study for the FDA. It's a 510K winning, it's a device-based safety type approval. We expect to have full recruitment by end of this year. And then we have the 12-month hold to apply for the 510K. And the first half of 2019, we expect to introduce it to US.
And then alongside with that, you recently struck a deal with Philips for a product called Sonalleve, which is available in Europe, but also you're looking for
yes.
North American approval eventually.
That's right. So this is a very big idea. And so the idea is it's really about creating a platform that can treat complex diseases, including cancer. And if you look at that portfolio, today these diseases are treated by either surgery or radiation or chemotherapy. And most of us know somebody who has gone through these things. And the side effects are severe. The cost is like $200,000 a patient on average. And most patients end up with multiple visits to the hospital. And so the idea is if we can take a real-time MR, which is what we do for our Tulsa product, and we can then combine that with this ultrasound source, and not only then with our product we treat prostate, with Philips, the Sonalleve product can treat other diseases such as fibroids in uteruses where women have severe pain and disease because of fibroids. So this Sonalleve product is it's taking the same idea, only it's treating the patient for this fibroids disease. And we think ultimately we can combine our current product and the Sonalleve into a single platform that can treat multiple diseases.
Is it fair to say that Philips' involvement here is as an interested partner, and this is not just an asset that they were just looking to sell that was non-core?
Well, absolutely. I mean, part of it is that Philips is now, taking our stock instead of cash, so they want to ride the upside with us, and they made it very clear from the very beginning that that was their intention. The second part is that they will become a stronger distributor for both of our products worldwide, and that allows a smaller company to have a big brother with a brand name and the access and the sales team to be able to take the product, which gives us confidence as well. We know how to evangelize new things, so that's what we will bring to the party.
Now, you mentioned the stock. Echelon Wealth Partners did a report recently they've got a $5 target, which gives
Yes.
you more than 300% upside in the next year. They see revenue going from 14 million in 2018 to 150 in 2020. So basically tenfold, and then profitable ultimately in 2021. Are they on the right track with these numbers, with these projections?
Yes. So Mark, I cannot comment on the exact numbers because we have not provided guidance. But I can tell you that companies like these can experience explosive growth. And the part of the reason is that this business model is designed so that we have a capital product that we sell through these partners, but then we would be selling disposables that are sold directly by our sales team. And to be able to get, for example, $2,000 per patient, we need something like 50,000 patient run rate to get to $100 million revenue. So I think the potential is absolutely there.
And if and when you get to $100 million in revenue, does Philips come knocking and say, hey, I think we want to tuck you in?
I mean, companies like this certainly also get sold, and Philips or any of the other MR companies or any of the medical device companies that are looking to go into treatments could be interesting companies. But certainly, I think an exit is a possibility for us.
Arun, we often talk here at Capital Ideas TV and Capital Ideas Research about investors liking the fact when there is a management team in place at a certain company that's proven it before. They've done it before. You've done it a few times before, building basically from startup to billion-dollar company. So what have you learned over the years that you want to apply to Profound Medical?
No, I think you're right. It's a lot of learning that you have to do. So the two companies I've done here in Canada before, one, I was president of Sidara Software, which was a medical imaging software company. The second one was Novadaq, which just got acquired by Stryker for about $1 billion Canadian. So the key things that I've learned is that small companies have certain competencies, which is in technology. It's also in evangelization by building great relationships with key opinion leaders around the world who can guide you into the right kind of clinical data and developing really, really powerful business models that will work for win-win for everybody's stakeholders, right? Those are some of the things that I kind of think I bring to the party. And you can see that I'm starting to do the same thing by building the relationship with Philips. We already have a relationship with Siemens, and we're already getting calls from other large companies. So part of the learning really is to have deep, strong relationship with senior management at large companies who can help you get your foot into the door at big hospitals. At the same time, be very high speed, very strong in innovation that a small company can do, and make it patented innovation so it's hard for someone to copy. And in parallel, start to grow the revenue line. So we're not just a technology company, but we also have revenues that investors can watch routinely.
VersaPay is a small cap that recently struck some big deals, including one with RBC. The company specializes in cloud-based invoice technology. They are growing their revenue at triple digits, and profit is soon to follow. Here's our conversation with the CEO of VersaPay, Craig O'Neill. So Craig, first off, tell us about VersaPay's flagship product, ARC. What is it and how does it work?
So ARC is something that's revolutionizing the back office of businesses. So kind of the sleepy area that nobody sees, accounting, getting bills out to customers, business customers, and getting paid. We go into that area and we really automate and really reinvent how that process has been done. A process that hasn't changed in I often say decades, it's really in forever. It's a manual process, paper-based. We remove the manual work and the paper, take it into the cloud, and make everything work really seamlessly.
So tell us how it's different and how you differentiate yourself from, we were just talking off air about EDI, electronic data interchange, which you say has been around a long time. Or how do you differentiate from, say, what CORTEX Business does, that kind of thing?
Sure, okay, yeah, so two kind of separate things. So EDI is a technology that has been around a long, long time. Often forced on smaller companies by big companies for the right reasons, big companies that wanted to automate. A technology that's hard to implement, hard to deploy. There's many companies that have cut their teeth on and built large businesses helping businesses get onto EDI. So we want to make something like EDI much more accessible to the everyday business. Now, For us, everyday business could be somebody that does 10 million in revenue up to billions in revenue. But it doesn't have to be a multi-billion-dollar company. So it's a new way to do electronic interchange between businesses. It's easy, it's secure, it's cloud-based, so it's in the cloud, it's everywhere, it's 24/7. So it's using modern technology, collaborative techniques and technologies, open technologies, to do really what EDI attempted many, many years ago. So that's part one. Part two, CORTEX. What's the difference from CORTEX? Most companies that are in the space of helping suppliers and buyers communicate are really more on the buy side, the buyer side. Often it's buyers that dictate the relationship. There's very few suppliers that say to a buyer, hey, you may want me to communicate this way, but I'm going to communicate that way, and like it or leave it.
Right.
We've got suppliers or vendors of goods and services say to us, we'll take payment in a bag of cash if they want to pay us that way. So they'll do whatever it takes to get
Right.
customers and pay. So CORTEX really started out helping buyers in the oil patch, big oil companies, get out to their suppliers. And for that reason, a lot of their functionality is kind of buyer-centric. Helps the supplier as well, but it's largely buyer-centric. And you see that in the makeup of their customer base. So we are supplier-centric. We go out to manufacturers, distributors, transportation companies, media companies, and we say, hey, we're going to help you get paid faster, and your customers are going to love it, so they're going to get on and use the platform.
So your company recently struck deals with RBC and Livingston International. The analysts that cover the company say this is gives you more visibility, it de-risks the story. So tell us about those two separate deals and why they're important.
Yeah, so, and they are critically important for us for a couple of different reasons. I'll start with Livingston. We started out in the space about 2 years ago saying, we're running a science experiment here. We're just doing something very new and innovative. Would companies use it? And so we started with mid-sized companies, some small companies, and had a lot of success. Now we're beginning to get the interest of larger and larger companies. So another big announcement earlier in this year was Intuit. So software company in the accounting space searched the world, said we need to reinvent how we bill our customers and get paid. Thought about building the software themselves as an accounting software vendor, and eventually bought from VersaPay after doing a worldwide search. So equally important, Livingston looked around, said we need to reinvent our AR. We do hundreds of thousands of invoices every month, and they picked us. So it shows that we can deal with large, very large multinational companies as well as mid-sized companies. So that's huge, because there's lots of multinationals that need what we do. So that's part one. Part two, RBC. There are many, many large multinationals. If you look at mid-sized companies as well, there are literally hundreds of thousands of businesses in North America alone that could use what VersaPay does. I've got a sales marketing force of 12 people. We can't get to hundreds of thousands of businesses. Mm-hmm. So we really are a channel play. And if you'd asked me 2 years ago, I would have said the ideal partner for us is a bank with a very successful commercial bank and cash management arm. And you could argue that RBC is the preeminent bank in Canada in terms of commercial banking and cash management. So began speaking with them a little over a year ago, got their interest. When they saw what we were doing, they were very, very excited, and it's taken about a year to get to this point. But they have big plans to roll out to their customers, and not just roll out ARC, our platform, but to bundle it with other solutions. So things like lending. You think about lending matched up with our platform, and a bank having real-time 24/7 visibility on a company's AR, which is really the collateral for lending. It's a pretty powerful combination. So it gives us incredible market reach into the Canadian market.
How big is this market overall, would you say?
Yeah, I often say when I'm recruiting people, and I say it to investors as well, this is a once-in-a-career opportunity. And I'm a multi-shot software entrepreneur, so that's kind of saying something. I've had some good opportunities in the past. But this one is different in that there are literally hundreds of thousands of companies that could use what we do, potential customers, and there isn't a lot of competition. So it's not hard, I won't go through the formula, but it's not hard to say on a conservative basis in the US alone, this is a $5 to $6 billion US recurring revenue opportunity. So we've just scratched the surface so far. And as I said, there's not a lot of competition. So we've got a great opportunity to make a land grab and grow very quickly.
Take us out 3 years, hypothetically, with the RBC deal. How much of the revenue from that transaction is recurring, roughly? Like, what's the percentage?
95%.
Okay.
Yeah. So When I joined VersaPay 3 years ago, and we started this journey into building ARC, the goal really was to have a very, very quick, unlike EDI, a very, very quick setup and very low cost setup, and then pure recurring revenue once you go. So we're really building an annuity with clients. And RBC's bought into the same idea. So they want to get their clients up and running very quickly, and then it's keep them on the platform, keep them happy and healthy. And we know that they will be, given our track record with our 106 clients that we have to date. So that's the plan. And RBC is just one bank that we'll work with. We're talking to a number of banks in the US and some other banks in Canada as well.
Let's talk some other numbers here. One of the analysts covering you is estimating revenue rising by more than 100% next year and then 255 in 2018. Does that sound roughly in line with what you're looking at, that kind of growth?
It does. Now, we have a direct sales force, and all of our revenue is direct sales right now, and the partners are now getting rolling. So RBC being the biggest one, and then Ricoh in Canada is also their outsourcing division and their services division. People think of them as a printer and copier company, but they do a lot of services, so they're reselling the product as well. By next year, probably a third of our revenue will be partners. The year after that, half, and the year after that, 80% of our revenue will be through channel partners. And even at that point, given our projections, kind of in line with what the analysts say, we're still well under 1% market share, market penetration, so lots of room to grow with the right partners in place.
How much cash do you have, and when do you expect to be profitable? Next year sometime?
Yeah, so we have about 8 to 9 million in cash on the balance sheet right now. Our current projections will turn profitable towards the middle to end of Q3 of next year, so we're investing strategically in R&D and sales and marketing. We're looking at M&A opportunities. That would change things if we decide to make a move there. There's been some good opportunities we've looked at. If we sign 3 US banks as partners, that could change the equation as well, but right now it's Q3 of next year.
And lastly, if an investor is watching this, would you say to them, you might really want to pay attention to us because we're at an inflection point, we're at an exciting time in our history?
Yeah, so a company like us, the yin and the yang, I often get the question, why now? Why invest right now? If you've watched our stock, we were $1.35 last Tuesday, we're around $1.90 today. That doesn't happen every week.
Missed that one.
It doesn't happen every week. So really my answer to investors is we are building a business which will succeed and grow very, very substantially over the next 2 to 3 years. So you need to take a 2 to 3 year view, but the time is now, because we will hit points where we see the stock pop. But we're just getting started from $1.35 to $1.95 or $1.90 perhaps. I haven't looked lately today. We're just getting started. We think there's a lot more room to grow the value in this company. So the time is always now to get in, because you know what's going to happen next week, and there's a lot of growth ahead.
From the heart of the financial district in downtown Toronto, that's our show for this week. I'm Mark Bunting. Be sure to subscribe to our Capital Ideas TV YouTube channel so you don't miss an episode. And if you want more great investment ideas through our weekly digest and morning note, subscribe to capitalideasresearch.com. Thanks a lot for watching, and thanks for investing like a pro. We'll see you next time.